Happy New Year's, y'all. It's your boy, Charles Enoch. Y'all already know we back with the first episode of Invest in Myself of 2022. So run the intro. So I hope everybody had a good holiday season. It's been a little while, so there's a few things I want to talk about before going into the video. So your boy is finally monetized. So I want to thank everybody that has supported the channel week in, week out, smashing that like button, being a subscriber, sharing my videos, and a special shout out to anybody that has donated to my Patreon. I definitely appreciate all of it. Now, my next goal is to get 10,000 subscribers by the end of the year. Now, I know it's a crazy goal, but it's my goal, so let's make this thing happen. No, but really, I do got some amazing things coming down the pipeline for this channel. So stay tuned and please keep supporting the channel. I really appreciate it. Thank you, thank you, thank you. So today, I want to talk about how to pay off your credit cards by using your credit cards like a bank account, meaning you will be putting money in your credit card and then you would draw money out of your credit card. So very similar to going to the bank, making a deposit or making a withdrawal. And I mean, with the holiday season passed and everybody out there, they were doing the cha-cha swipe. One swipe this time, two swipe this time, Nah, but seriously though, when trying to pay off your credit cards in the most effective way, we do want to adopt the velocity banking strategy of income pays credit, credit is going to pay our expenses. See, when we're able to put money onto our credit card, it reduces our interest. And if we're able to pay the credit card statement off, then we avoid interest altogether for that month. Now, once we put the money onto our credit card, we pretty much deposit the money onto the credit card. That money is not lost. We can pretty much withdraw it. We can use our credit card to pay our expenses. Now, the only way this strategy works is if you have a positive cash flow, meaning the income that you're bringing in is more than the expenses that's coming out. So for example, if you owe $2,000 on your credit card, and let's say your paycheck's $2,000 and you put $2,000 onto the credit card, it pays that credit card off in full, meaning you avoided interest. Now, let's say your expenses are $1,500. You can then in turn use your credit card to pay those $1,500 worth of expenses. This will leave a balance of $500 left on your credit card because your cash flow is $500. So ideally, you would pay off your credit card in 4 months, 500 times 4, 2,000, and you would avoid interest because you're putting your paycheck onto the credit card. You're pretty much depositing the money onto the credit card, paying it off in full for that month, and then you'll use that to pay your expenses. Now, the example that I just said is a perfect scenario. So not in all cases can you avoid interest, but you can reduce your interest significantly when you're putting the money onto your credit card. Now, I know this may sound confusing, but you already know I got the whiteboard in the back. I'm gonna have a real life example for you guys. So let's get started. Let's get to it. All right, so we're on the whiteboard here. Let's break it down. You already know I get down to business here. So we're gonna have an individual. We're gonna say that their income per month is $4,000. Their expenses are $3,650, meaning their cash flow is gonna be $350, pretty much income minus expenses, right? Now, the debt that they have, they're gonna have 3 credit cards that they have a debt on. We're gonna just say that the interest rate is 25%, so it's a high interest rate here. So credit card 1 is gonna be maxed out. They use $950 out of the $950 they have available. Credit card number 2, they use $375 out of $600. And credit card number 3, they use $570 out of $700. Now the minimum payment on Each of the credit cards we're going to say is $25 each. So that's the minimum they have to pay per month on the credit card. Now, the expenses they have to pay in cash is going to be the rent. The rent is going to be $1,800, and they have a loan, and the loan is going to be $800 that they have to pay on, and they can only pay cash on that. So that amount's going to be $2,600. Now, the expenses that they can pay via the credit card will be their internet bill is going to be $100, electric is going to be $80, car insurance is $200, car loan is $300, gas is $150, and groceries is $220, which leaves that at $1,050, pretty much totaling their expenses of $3,650. All right, so we're on the other side of the board. So let's break this thing down, see how this individual is going to use the velocity banking strategy to pay off the credit cards by using the credit cards pretty much like a bank account. All right, so month one, we're going to use cash to pay both the rent of $1,800 and the loan that this individual has of $800, totaling $2,600. So remember, their income is $4,000. So however they're getting their income, weekly, bi-weekly, whatever, they're going to save $2,600 in cash and use that to pay the rent and the loan. Now the remainder of their money, $1,400, the remainder of that $1,400, they're going to put onto the credit cards. So they're pretty much going to be transferring this money onto the credit cards. So credit card one, they're going to be putting $950 on credit card one, meaning that they paid it off in full. This avoids the interest on credit card one. So we avoided 25% interest. Increases our cash flow by $25 because it's no longer an expense, right? Now credit card two, we're going to put $375 on credit card two. That also pays off credit card two. We avoid any interest, increases the cash flow by $25 because that was the minimum. It's no longer an expense. Now credit card three, we're going to put the remainder of our money, we only got $75 left, on credit card three. So we did not completely avoid interest, but we did reduce it, right? Because we put 75 on it. It's better than putting 25 on it. Now, what we're going to do, we're going to pay our expenses with our credit card, the remainder of our expenses. Remember, the remainder is $1,050. So first, we're going to use credit card one. We're going to pay $950 on credit card one, pretty much maxing it out. But again, we don't care because when we use that payment, when we transfer $950 onto the credit card, it's going to say that we paid it off and it's going to move it towards next month. So it doesn't matter if we max it out, right? So credit card number three, we're going to pay $100 on there because we got to pay $1,050. So now we've completed all our expenses for the month. So the credit card balance, this is how it's ending. Credit card number two is paid off because we didn't use any money on credit card number two. So that's paid in full. Credit card number one has a balance of $950 on it. Remember, we avoided any interest on there. Credit card number three has $595. Remember, we put $75 on there and then we had to use $100 of it. Now, in this example, we did not calculate the 25% interest on there just to keep it simple. But this is how it's outlined there. So for month two, we're pretty much going to be recycling and doing the same thing, but we are going to keep on hammering this thing down so you get the full understanding. So month two, this arrow means that it's the same thing as month one. So we are going to use the cash of we're going to use the cash of $2,600, right, to pay first the rent. $1,800 is our rent, and we have a loan that's $800. So out of the $4,000, we got to use $2,600. Now the remainder of our income, which is $1,400, we're putting it onto our credit cards, right? Because we want to try to pay it off in full to avoid interest. So credit card number one, we're going to be doing the same thing. Put $950 on there. We avoided interest for credit card number one. Cash flow increased by $25. Credit card number three, the remainder of our $1,400, we're going to put $450 on credit card number three, so we reduce a lot of the interest, right? So the next step, we're going to be doing the same particular thing. So our expenses are $1,050. First, we're going to use credit card number one. That's $950. And then credit card number three, we're going to use $100 on there. Now, when we look, the credit card balance, credit card number two is still paid off in full. Credit card number one, it's $950 as the balance, but we did avoid any interest, right? Because first, we transferred $950, meaning that we paid the credit card off in full, push it out to the next month. The other credit card number three, we put as much as we could onto the credit card, which reduces the interest significantly. So the balance on credit card number three is only $245. We can see that the credit card is lowering by $350. That is pretty much our cash flow. So the money that's always left from the income minus the expenses, it's going to be left on the card. So it's reducing it. $595 minus $350, go to $245. So this is how we're slowly paying off the credit cards, and we're avoiding interest on credit card number one in total. So we're on month number three. We're repeating the same cycle. I think we're getting it, but we still gonna hammer it down, right? So month three, we gotta use $2,600 of our income, the cash, straight cash. We're gonna pay the rent, $1,800, keep a roof over our head, and we're gonna pay on the loan that we have. So that's $2,600 out of our total $4,000 income. Now, the remainder of our income is gonna be $1,400. We're shoving that money onto our credit card. We just transfer it onto the credit card, right? The money is not lost. Once we put it in, we can instantly use the credit card. So again, we're gonna avoid the interest on credit card number one by putting $950 on there. Credit card number three, we're gonna avoid interest actually because we're gonna pay it off the $245. Now the cash that we have left over, because if we add both of those up, it doesn't equal $1,400. So the cash that we have left over is $205. Now this step, you're gonna first pay your expenses with the extra cash that you have. So you have $205, and the expenses that we owe are $1,050, right? So we're going to use $205 of cash, and then we're going to use credit card one, and we're going to get the remainder amount. We're going to use $845 on credit card number one. So the credit card balance now, credit card two, it's been paid in full since month one, right? Now credit card number three is actually paid in full now. So now we're just focusing on credit card number one, $845. That would be the balance on there. Now again, credit card number one, we have not paid any interest at all. Remember, when we transfer that money onto the credit card, it says that it's paid, and then it's going to push the due date payment back to the next month. So that's why we're doing that transfer, and then we're just charging our card, right? Doing the cha-cha swipe. So month four, I think we got it down, but let's finish it off month four. So we're gonna use cash to pay again the rent, the roof over our head, $1,800, and then the loan of $800 that we have. That's $2,600. Now the remainder, our $1,400, we're gonna use $845 to put on credit card number one, right? Do the transfer, that pays it off in full. We avoided any interest on there. Now, the difference of the $845 and $1,400 is $555. So we're going to use the $555 that we have left over in cash. We're going to use that to pay majority of our expenses. Remember, our expenses are $1,050. So once we use $555, we're going to use credit card 1 and pay the remainder $495 on credit card number 1. Now, the credit card balance ending for that month, credit card 2 been paid off, credit card 3 we paid it off since last month, and credit card 1, if we take a look, it was $845, that's down to $495. So that's the $350 cash flow. Remember, income $4,000, expenses $3,650. So we see that it's going down by $350. So now I don't have enough space on the whiteboard, but we can see if it's going down by $350, we will repeat this step for month 4 for 2 more months, and then credit card 1 would be paid off, and we avoided all the interest on credit card number 1. So again, if you see what we're doing, we're pretty much using our credit cards like bank accounts, right? We're just depositing our paycheck onto the credit card, pretty much paying that off in full, and then we're withdrawing. We're pretty much swiping our card using the money that we put in to pay the expenses that we can pay. So when you're doing this method, you first, number 1, want to figure out what you can and cannot put on your credit card, right? So for this individual that I did, we seen that rent would be wise to pay in cash, and the loan that this individual had, pay in cash. Everything else we could pretty much put on the credit card. So anything that we can put on the credit card, we're using our cash to deposit it into our credit card, and then using our credit card to pay that expense. So remember, with Velocity Banking, it's income pays credit, credit is going to pay our expenses. Now, I hope this scenario was helpful for you guys. If it was, definitely leave a comment. Matter of fact, go ahead down at the bottom, say Happy New Year's as a comment. If you did see the video fully from start to finish, let me know. Just say Happy New Year's. And like always, if you enjoy my videos, remember to smash that like button. If you're new to the channel, go ahead, take that little bit of time to subscribe. Remember, I'm trying to get 10,000 subscribers by the end of the year is my goal, and we gonna make it with the help of you guys. And like always, you guys have a good weekend. Happy New Year's. Hopefully everybody makes their New Year's goal and resolution and keep striving to be a better person. Peace out.